So, the market rally, it extended to a third straight day. The Dow Jones Industrial Average advanced a massive 664.18 points.
Wow.
That's 1.43%, closing over 47,100 at 47,112.45.
And, if you just look at that closing number, you might think today was just a day of pure smooth sailing.
Right.
But that was a V-shaped rally. The S&P 500 had actually spent time down 0.7% at its session lows.
And it happened despite some deeply concerning, fundamentally negative economic data hitting the wires today.
Exactly. It's a classic case of policy speculation completely overwhelming reality.
It's the paradox that defines this market, isn't it? Where bad news consistently translates into, well, buying momentum. So that's really the big story we need to unpack. These two dominant competing forces driving asset prices.
Yeah, on one side, you have this extreme, palpable Main Street consumer anxiety.
And on the other, just pure policy-driven optimism that the Federal Reserve is ready to perform a market rescue.
And that optimism won the day, hands down. And the single largest catalyst that shifted the mood from negative to euphoric came straight out of Washington.
All about Fed leadership speculation.
All about it.
Treasury yields just plunged the moment the news broke. Bloomberg reported that White House National Economic Council Director Kevin Hassett. He emerged as the frontrunner for the next Fed chair.
And for anyone following bonds, the response was instantaneous. You couldn't miss it.
Not at all.
Exactly. When the market sees Hassett, they see someone who would accelerate interest rate cuts.
Aligning with political desires.
Perfectly. It was a massive psychological signal. The immediate specific impact on the benchmark 10-year Treasury yield was a 0.03 percentage point decrease, easing it right down to that 4.00% level.
And touching 4.00%, that is the critical technical and psychological benchmark we haven't seen consistently since, what, late October? That's a huge line in the sand.
It is, because that speculation didn't just move yields. It forced market participants to reprice the odds of release right now.
Okay, so how dramatically did this affect the predictions for a December rate cut? Because just last week, we were having conversations about higher for longer. Things felt much more cautious.
We were, and that just shows you the depth of this shift. Before the Hassett speculation, the odds of a quarter percentage point cut in December were below 40%.
And now?
Now, markets are pricing in an almost 83% chance of that cut, according to the CME FedWatch tool. That is an enormous reversal.
Wow.
Fueled not by new inflation data or jobs reports, but by political speculation alone.
That swing from under 40% to 83% in just 1 week on speculation?
That's just staggering. Does this mean the market has completely surrendered to the policy narrative?
It definitely raises that question, right? Is the Fed's willingness to ease now going to trump any underlying data that comes out? The market is showing immense elasticity toward these dovish rumors.
And it wasn't just speculation.
No, you add that sentiment to the reinforcing signals we got from other existing Fed officials, and the narrative becomes extremely potent.
So what were those other signals? Well, you saw clear signs of institutional alignment. New York Fed President John Williams recently spoke about the likelihood for further adjustment in the near term for rates.
Okay.
And then you had San Francisco Fed President Mary Daly and Fed Governor Christopher Waller, both explicitly supporting the idea of lowering rates recently. Daly specifically mentioned a December cut possibility.
So whether it was coordinated or just convenient timing, the dovish message is being layered on thick. It gives a lot of cover for this rally, even before a new chair is installed.
That's right.
Okay, so that explains the optimism. Now we have to turn to the other half of the story, the economic reality that Wall Street is cheerfully ignoring. And the biggest red flag today was consumer sentiment.
The slump there wasn't just significant, it was concerning. The Conference Board's Consumer Confidence Index for November tumbled to 88.7.
A huge drop.
A serious 6.8-point drop from the prior month. It's the lowest reading in 7 months. And crucially, it massively missed the 93.2 estimate that economists were hoping for.
When confidence falls that dramatically, what are people actually saying? What's driving this pessimism?
It's the same list of anxieties we've heard for the past year. High prices, persistent inflation, the threat of new tariffs, trade instability, and, political gridlock.
And what's really telling is their view of the present.
Exactly. For the fourth straight month, more consumers they surveyed indicated they believe the economy is already in a recession.
That is an incredible disconnect. The stock market is trading near all-time highs, yet the consumer, the engine of the economy, believes we are already contracting.
It's worse than just a belief, because if you look at the sub-indices, you see the actual recessionary tripwire, the forward-looking expectations index. It tumbled even further to 63.2.
And that's the crucial number.
That is the one. Historically, that 80 threshold is what signals a coming recession within the next 12 months.
So 80 is the line. Where have we been relative to that?
We have tracked below 80 for 10 consecutive months now.
10 months.
10 months. So if 80 is the tripwire, the fact we've been below it for nearly a year means that warning light isn't just flashing, it's permanently fused onto the dashboard.
And on top of consumer anxiety, we also got some concerning labor market data.
Indeed. The ADP private payrolls report. It indicated private companies shed an average of 13,500 jobs per week in the last 4 weeks.
Which is an acceleration.
A serious acceleration of job losses compared to the prior update, which was only 2,500 weekly jobs lost. Deteriorating labor data with low confidence. That's a classic recipe for caution.
So let's bring it all back together. We have a major recession indicator flashing red for almost a year, accelerating job losses, and the Dow surged 1.43% today. It sounds like Main Street is looking at its savings while Wall Street is having a champagne brunch.
Yeah, that analogy really nails the tension here. And we explain this massive paradox through the lens of the bad news is good news thesis.
Right.
The deteriorating economic sentiment, the confidence collapse, the job losses, it all just strengthens the case for the Fed to step in. For December rate cuts,
So the market is betting on a rescue.
it's betting the Fed will rescue asset prices, effectively looking past the fundamentals. This is why we're seeing this widening chasm between Main Street pessimism and Wall Street optimism. The S&P 500 is trading only 2.3% below its late October all-time high. The market is just addicted to the policy pivot.
Let's pivot to specific stocks then, because even within the winning sectors, we saw some serious divergence. The AI trade, for example, showed fresh pressure today. What happened with Nvidia?
Nvidia shares fell 2.6%, closing at $177.82. This was driven by a major report from The Information suggesting a potential competitive threat.
A threat from who?
Specifically, Meta is considering using chips designed by Google, their tensor processing units, or TPUs, in 2027, and maybe even renting them next year.
That sounds like a pretty aggressive move. What makes Google's TPUs a genuine threat to Nvidia's dominance?
It's all about this growing trend of custom silicon. TPUs are specialized, custom-designed chips optimized entirely for massive-scale AI processing.
For their own data centers.
Right. So if a huge customer like Meta starts exploring custom rival silicon, it threatens the long-term volume and pricing power of Nvidia's more general-purpose chips. It signals that even the biggest players are looking for ways to cut costs.
And that created a split trade in tech right away, didn't it?
It did, a very clear one. Nvidia fell, but the beneficiaries rallied hard. Alphabet shares, Google's parent company, rallied over 4%. And Broadcom, another player in that custom silicon space, also saw a significant boost.
So the AI money is getting more selective.
Hyper-selective. It's no longer lifting all boats equally, just based on general AI sentiment.
And the selling pressure on Nvidia, it seems to be becoming a bit of a pattern.
That's the key takeaway. This is Nvidia's third consecutive week of selling pressure, even after they delivered record Q3 results just last week. It shows that valuation scrutiny is intense.
People are looking past the hype.
They are. Investors are now acutely focused on competitive threats and whether these high-flying companies can maintain their margins. It's fueling that whole AI bubble debate at the top of the market.
Okay, so outside of that mega cap AI battle, where did the buying concentrate?
We saw strong rotation into consumer discretionary names. These are often seen as interest rate sensitive, so the hope of a Fed pivot really brought buyers out.
Any standout examples?
The best one was Kohl's. It soared 23% after dramatically beating analyst expectations. They reported adjusted earnings of 10 cents per share versus the 20-cent loss that analysts were expecting.
Wow, that's a huge beat.
An upside surprise like that in retail is extremely rare right now. It suggests some of these stocks might be set up for massive gains if they can just clear a very low bar.
And what about the small cap names? They're the most sensitive to borrowing costs.
Absolutely. The small-cap Russell 2000 continued its outperformance, gaining over 2% today, plunging Treasury yields and the spike in December cut odds. That translates directly into risk-on buying for these smaller, domestically focused companies.
Okay, moving beyond equities. Let's look at how this policy speculation played out across other asset classes. The retreating U.S. dollar was a big factor.
A major tailwind. The DXY, the U.S. dollar index, fell to around 99.88 today.
And that weakness, driven by the expectation of Fed easing, that was a clear boon for what, non-yielding assets.
Exactly. Precious metals were supported. Gold rose slightly, up 0.07% to $4,138.45. Silver, while it dipped a bit today, continues its impressive year-to-date outperformance. It's benefiting from both safe haven flows and strong industrial demand.
And the risk-on sentiment obviously extended into the crypto space.
It did. The Bitcoin recovery continued, up 1.40% to 88,343 cents. The whole sector was lifted, really. 9 of the top 10 coins by market cap appreciated. XRP was up the most, 7.9% to $2.23.
But the underlying sentiment, it seems totally divorced from that price action.
It is a profound disconnect. Despite the strong price moves, the crypto fear and greed index is still very low at 15. That is deep in extreme fear territory.
So what does that suggest?
It suggests that while institutional money might be driving prices higher, based on global risk-on conditions, the average retail investor, the person captured by that index, remains deeply scared or skeptical.
It's a sign of institutional positioning overriding retail anxiety.
That's a great way to put it.
Finally, what about real estate? Perhaps the most obvious beneficiary of collapsing rate expectations.
Real estate investment trusts, or REITs, they rallied as yields compressed. And crucially for the average consumer, this move pushed mortgage rates to new 2025 lows. They're trading around the 6% range now.
Which is meaningful relief for prospective home buyers.
It is. It's tangible. But, even if rates drop further, the fundamental problem of supply is still there.
The rate lock-in effect.
Precisely. The rate decline is good for affordability, but it doesn't magically solve the supply shortage. Most existing homeowners have mortgages well below 6%, so they have zero incentive to sell or move. That keeps inventory tight.
Okay, so as we look ahead, we have to remember this is a short week, but it is packed with high-stakes data releases.
It's a critical, compressed week. Wednesday specifically is pivotal. It might be the ultimate stress test for this whole dovish narrative.
What are we getting?
We get the Q3 GDP second estimate, durable goods orders, and most critically, the PCE inflation release. That's the Fed's preferred inflation gauge.
And since this whole rally is built on the Fed cutting rates, any sign of sticky inflation from that PCE report could just instantly dismantle this entire narrative?
Absolutely. This is the last major data before the FOMC blackout period begins on November 29th. It's going to determine if the market's extreme optimism is validated by the numbers or if it was just, wishful thinking fueled by a rumor.
So let's finish with some key technical levels for people to watch.
Okay, first, for the stock market, monitor the S&P 500 resistance zone between 6,800 and 6,850. Reaching that level would put us extremely close to the all-time highs.
And what about bonds?
Second, and arguably more important for the macro trend, is the 10-year Treasury yield. Given that it touched 4.00%, breaking decisively below that is now a real possibility. If it breaks, that could accelerate the move toward 3.90% and just pour more fuel on this fire.
So the market is riding a wave of speculation, betting on the Fed to fix things, but that bet gets fully tested on Wednesday. The level of optimism just feels fragile. I mean, can markets really sustain this enthusiasm for monetary easing, even as the fundamental economic picture continues to deteriorate so dramatically? That's the core tension heading into the end of the year.
And that's going to do it for today's Daily Consolidation. If you found this helpful, make sure to like the video and subscribe to the channel. We put out new episodes every trading day after the market closes. Thanks for watching, and we'll see you at the next class.